Good morning, students. Today, our webinar is on structured finance. In this topic, we will be covering details about the securitization, the process, the financial modeling for the securitization, and also we would be covering credit derivatives. In the credit derivatives, we would be covering credit default swaps, credit-linked notes, credit-linked deposits, then repackaging, then CDOs, etc. and etc. Okay, so we would try to, as it is a one-day seminar, so we would try to cover as many topics as possible, and if time would permit, we will be doing the live financial modeling for the securitization transaction, and I'll be circulating the financial model, the solved financial model, as well as the rating rationale for the securitizations transaction in the second half. So let's begin our webinar with the help of first with the securitization. That is, let's first understand what is securitization. To begin with, we will discuss what is securitization, how it is different from the traditional lending or the corporate finance. So basically, securitization is a process in which non-tradable assets are packaged and converted into security and then sold. It is a process in which entity securitize its asset is not borrowing but selling a stream of cash flows that was otherwise to accrue it. It is also a device of a structured products in which an entity seeks to pull together its interest in identifiable cash flows over a time, transfer same to investor either with or without support of further collaterals, or thereby achieve the purpose of financing. See, the difference between the traditional method of financing and the securitization is very big. Securitization, what happens in that, the originator means the person who has the assets in his books, identify the assets, that is the stream of the cash flows, okay, and then sell those stream of cash flows to the other investors according to their risk return needs. So basically here the identification of the cash flows is done, then these cash flows are repackaged and sold to various investors according to their risk-taking ability and according to their reward needs. In this, the beauty of the securitization is that it totally segregate the originator's balance sheet from the securitized pool. That is, the investors have only claim on the stream of the cash flows that is securitized. They do not have any claim on the originator's book, whereas the originator also does not have any access to the stream of the cash flows that's been already securitized. So basically in this, it helps us to achieve the bankruptcy remote structure. Now what is a bankruptcy remote structure? This structure means that even in the case that the originator is going bankrupt, okay, none of the creditors of the originator can have access to the cash flows or the stream of the cash flows that the originator has already securitized. And also it applies vice versa, that in case of the stream of the cash flows, if they are behaving very badly or if there are a lot of defaults are there, the investors to those cash flows would not be able to touch the assets of the originator. So there is a clear-cut segregation between the originator book and the cash flows or the assets that's been securitized. In a traditional method of corporate finance, a corporation raises equity obligations to own the assets. In securitization, a corporate creates and securitizes assets, that is, transfer assets in the form of securities. The claim is on assets and not on the entity, as we've already discussed, hence asset-based funding. Securitization and traditional funding. Now the question is the difference very big? Yes, because in securitization, all the claims are eventually claims on the assets. Now the question is one of the stacking order, that what is the order for the claims? Then in securitization, securitization puts investors on the top of the stacking order by the isolation, as we have discussed, that on the stream of the cash flows or on the assets, the investor will have the first right, and the originator, that is the person who has created the assets, who has originated the assets, would not have any access to those stream of the cash flows. The asset-backed funding narrows down asset definition and hence reduces the volatility. Now, how the volatility is reduced? Because in securitization, there are identifiable stream of the cash flows. They are the stream of cash flows against whom the security is created and is sold to the investors. Where in the traditional corporate finance, if you see, it's like there is no particular asset or a stream of cash flows against which the finance has been raised. It's a vast, like for the corporation, the entire finances which the corporation holds, the lending is against them. They are not identifiable the stream of the cash flows. Whereas in securitization, there are identifiable stream of the cash flows. Hence, in securitization, the need of the credit enhancement is there, but the credit enhancement needs are lesser than what we need in the traditional method of the corporate finance. Thus, the crux of asset-based funding lies in reducing the equity and increasing the leverage. So what happens? The securitization facilitates where the entity can reduce the equity and would help to, you can say, expand the business with the help of the leverage. Securitization and corporate finance. Now, in this slide, we have discussed about the various parameters on which the securitization and corporate finance are different. First is the nature. General claim against the assets of an entity, claim against the specific assets of an entity on mutually exclusive basis. In corporate finance, the claim is against the assets of an entity. Now the assets are not identifiable, that there are not particular assets against which the finance has been raised, whereas in the securitization, the claim is against the specific assets of an entity and on mutually exclusive basis. Objective: to harness the strengths of the corporate's balance sheet to raise funding, to strip the excess spread inherent in the assets and service them on off-balance sheet basis. Now, whatever the funding is raised through securitization is off-balance sheet, that is, it's not on the balance sheet, whereas the corporate finance funding is always on the balance sheet. It's never off the balance sheet. Investors' risk subject to entity-wide risk, like all the investors who have invested in the corporate finance instruments, they are exposed to whatever the risk the entity is having, whereas in securitization, the entity risk is isolated from the risk that the stream of the cash flows or the cash flows has. Structured funding: less amenable to structured funding, more amenable to structured funding since assets are hived off into a separate entity. Leverage limited to entity-wide prudential regulatory limits. Leverage based on the portfolio risk, usually quite high. Then comes the basic process of the securitization. That is how this is the very basic process. Now there can be many. The process can be structured according to investors' needs. The cash flows can be structured according to investors' needs. So thus, this is a very basic process of the securitization. Now, here what happens, see, the first is the originator. The originator either has or creates the underlying assets, that is the transaction receivables to be securitized. Okay, then selection of the receivables are done so that it's so as to securitize or assign the receivables. Now the SPV is formed. Now SPV acquires the receivables under a discounted value from the originator. The servicer of the transaction is appointed. Normally originator act as a servicer because the originator has originated the stream of the cash flows or assets. So the originator would be in a better position to service the entire transactions. In many cases there can be even the outside party who will act as a servicer. Now what is the role of a servicer? Servicer collects the receivables. Usually it's based on the escrow mechanism and pays off the collection to the SPV. Now the SPV either pass the collection to the investor or reinvest the same to the payoff. SPV has again two options, whether as and when the SPV receives the receivable, it can pass it to investors, or in other case, there can be the fixed dates for the payout to the investors of the SPV. So if the SPV is receiving the cash flows in between, the SPV can reinvest the cash flows to the date to which it has to pay to its investors. Okay. Now in case of the default, a servicer takes action against debtors as SPV's agent. Now, when only small amount of outstanding receivables are left to be collected, the originator usually cleans up the transaction by buying back the outstanding receivables. And at the end of the transaction, the originator profit, if retained and subject to any losses to the extent agreed by the originator in the transaction, is paid off. So it's a very, very simple thing. Originator originates the assets or the streams of the cash flow. Then the SPV is created. The originator identifies the stream of the cash flows to be securitized. SPV purchase the stream of the cash flows at some discounted value. Now the SPV will sell off the securities or notes to the investors. The investors, whatever the money the investor will give it to SPV, would be transferred to the originator as a purchase price. Now there can be the trustees. Trustees are appointed to look after the entire proceeding, whether all the documents are placed, whether the investors to the SPVs are getting their money on the timely payment, whether all the calculations and profit and accounts, etc., are maintained in a timely manner.